kick off with Mike Muller, sitting in Singapore. Good morning, Mike, as you wake up this new year, $86 on the barrel. What's the first question to ask? I mean, what does the year ahead look like? What are the big ideas? Are you surprised to see prices back at these levels, given the sort of general outlook, supply and demand?
Yeah, I mean, let's just repeat the numbers. I mean, $86.50 Brent is pretty much the highs of the move in October last year. And to go back to when we were at or above that level, there was an $86.70 print in, I'm looking at it here, in October 18. But then any higher than that, you have to go back to 2014 when prices fell off that plateau they'd established for about 4 or 5 years at $100, $110, $115 a barrel. So we are pushing towards this triple top of the market and possibly new highs. But WTI is close to $84 a barrel. That's come along even faster. And of course, given you have a much more responsive upstream scene with investment prospects in the Permian Basin there, that's incentivizing drilling and so forth. And the other one we need to start mentioning in the same breath, of course, is European gas, which has been making all the headlines while you've had your recess here on these sessions, which had gone as high as 180 something euros per megawatt hour, and that's now sitting at 83 as well. So those markets have definitely been extremely active and volatile. So am I surprised was your question? If you look at global inventories of oil and you look at the success of the OPEC plus concerted action to take inventories down to pre-pandemic levels, I mean, OPEC succeeded many months ago, but are continuing to forge on with their policy, so much so that many of their producers can't really put their share of the 400,000 barrels a day monthly increase into the market any longer, which has been a theme for many months already on these calls. The price is therefore very much in the hands of core GCC, and you can argue Russia. But global inventories are below pre-pandemic levels. And in many cases, there are pockets of tightness, which would have you say that a front-end backwardation and a strong market is very much justified. In fact, to put it very generically, there is only really one part of the world that has spare capacity in terms of refining capacity and in terms of inventories. And that is a part of the world where data is a little bit less readily available on a real-time basis, namely China. But in the rest of the world, you have a phenomenon in Europe where, despite the fact that the piece of the global demand barrel that is still missing is jet fuel, you have the regrade, as we call it, the differential between jet fuel and diesel, trading positive in Europe for the first time in a very long time. It's still inverted, it's still negative in Asia, but that tells you there's not enough jet fuel around in a market that is still missing a huge piece of aviation demand. 0.5% very low sulfur fuel, which propels ships, is tight. The inventories on that product are back down to the sort of levels we had pre-IMO, when the world was panicking about whether we could make and blend enough of that. And I could go on and on. There are some pockets of the energy complex that are less tight. I mean, margins for olefins, so for petrochemicals, are less stellar. So that has naphtha being one of the weaker products out there. But I could go on and on and on. Now, half an hour would be up here if we're not careful. So it is a very, very tight fundamental market, which underpins the backwardation we're seeing at the front of the market, which is 50, 70 cents at the very, very prompt, but then 80, 90 cents per barrel per month going into the back months. I think, yes, these prices are justified. And I think the fact that we've had a lot of risk-off mindset at the end of the year, there's a lot of managed money sitting on the sidelines that might say, hang on, oil looks like it's about to pop towards 90 and maybe even through that level. Let's not miss out. And if that money, which is currently on the sidelines, comes back into oil.
Before we get into China, which obviously I want you to jump in on, I first want to talk about the idea of supply. You mentioned in your first comment about this is a tight market in all of the obvious places. But ultimately, on the basic level of oil supply, every time OPEC Plus increases 400,000 a month, it's another month in which they get closer to their limit, right? To the point in which there is no new supply or extra idle supply sitting on the sidelines that can come in short order. We have Citi forecasting a decline in oil prices through the year because they see supply coming from all the traditional places, Permian, Brazil, Mexico, and so forth. I'm wondering your thoughts on that non-OPEC plus supply as a feature as the year gets underway.
Well, in short, the world needs it. You mentioned Mexico. I would strike them off the list as a place of increased supply. In fact, there's been some talk of them having less to export and wanting to be more domestically focused. There was even a headline about them not exporting any crude at all, which is a theme that there's also surfaced in Indonesia, which maybe we'll come to later. But no, I think all of these new supply sources, the ongoing investment in Brazilian deep water pre-salts, the Suriname and Guyana production, the big Exxon project there, a bit of extra oil coming out of Norway. This is all accounted for, and it needs to be on time. There can't be any delays in these projects coming on stream because the world is counting on having that supply. And that brings us to the more responsive stuff, which is twofold. It's Permian investment, and Christoph alluded to the rig count before. I mean, that will come, but it won't come in the same way because there's just physically no time for us to get a response from the Permian Basin and the rest of the shale sector in the coming months, which we're concerned about. And then what's left is the SPRs. And yes, we have seen a lot of posturing around that concerted effort that the Biden administration led to see some SPR releases in Japan, China, Korea, even the UK on products. And this was obviously taken into account and dismissed. It's in the price, and the market's saying more, please. So what happens if you destock your strategic petroleum reserves too much? That's along with the 2 million barrel day of supply cushion that Christoph was talking about. That is a comfort level or a layer of comfort that will not be there any longer. And some governments won't be comfortable with not having it and dismissing it. I mean, you can talk about Japan not needing it anymore with a sort of stable economy and an arguably shrinking population. But in places like the US and China, it's still extremely important to have these SPRs in place. So yes, the market is now at this $86.50 Brent level with SPR releases priced in. And the question is the Biden administration going to release even more? And what sort of response will that evoke? I think it's likely that there will be more. I mean, a couple of companies drew on the SPRs. They are rather cleverly structured as time trades, as exchanges, where you have to give whatever you took in the current market back in a year's time or so. But it's also fair to note that the uptake of SPR has been less than maybe was initially advertised. And we need to watch China because China is a lot less interested in releasing SPR in the low 70s than they might be here in the mid to high 80s. So it is quite likely that some will come there. But again,
I want to just switch a little bit to the China question, but also within the context of it as global growth. I don't think it's been a long time, both coming out of a year in which Chinese oil imports have declined year on year. And it's a long time since we started a new year in which the Chinese economic outlook looks for the first time somewhat precarious and unpredictable. We had, as part of our forum last week, a fairly respected voice on China, Xavier Chen, a former head of BP in China and so forth, calling that we have reached China peak oil demand at 14 and a half, 15. Your thoughts, Mike, start of the year, looking out to China, where it is, where it looks like it's going vis-a-vis energy demand, but particularly oil?
Yes, I think that's a bold call to say China is already at peak demand. I personally cannot see it. Yes, it is fair to say that China is right at the forefront of transitioning certain segments of their energy consumption economy. And from a geopolitical standpoint, it's something they clearly would like to do. But I cannot see how China has already peaked in terms of its oil demand, given that they're bringing on stream new refineries and new petrochemical facilities, and they have a currently semi-idled independent sector, often referred to as the Shandong teapots, and a few in Liaoning as well, which still have a lot of spare capacity. And only just a few minutes ago said that the world will need that capacity to kick into gear in order to supply itself. So China is grappling in the lead up to the party conference in October that will indeed serve to reconfirm Xi Jinping's longevity in power.
Coronate, is that the word? Coronate?
Whatever.
Yeah.
With a triple challenge, right? They are enforcing a policy of suppressing COVID, and they're facing a challenge there, which we'll need to come on to. They want to do something about deleveraging overheated, over-leveraged sectors, most visibly the property fiasco, which is a face-saving matter, I think, in terms of reassuring investors in China. And they want to sustain growth in the economy. And it looks like having all three of those pinned down for the rest of this year is a major challenge. But I don't think we need to get ahead of ourselves on China and COVID letting rip through China yet. I mean, the case count is still around 100 a day for a country of more than 1.4 billion people, with very high barriers to entry for the virus. I mean, colleagues of mine need to spend 3 weeks in quarantine if they return to China from visiting relatives in Singapore, for example. So yes, there have been some very high profile cases of people moving around China, transmitting Omicron from one place to another. We had our first case in Beijing yesterday, but we're nowhere near China seeing a major demand hit. The city of Xi'an, like 13-14 million people, closed down for the best part of 3 weeks. It's beginning to open up on a district by district basis now. And there's a clear difference in policy, I think, between Shanghai and Beijing, which cannot possibly be closed down in their entirety, and the provincial cities in the rest of the country, which can. So you have a largely vaccinated country, albeit with a non-mRNA vaccine that has a lower efficacy, and the transmission data is still very non-troublesome. But people are already speculating what happens if you get a major outbreak in a Chinese port. And of course, Tianjin on the doorstep of Beijing has had cases and has seen measures to lock things down. So people are already speculating on what would happen if you had Omicron hitting a major Chinese container port, and what that means for the supply chain, for consumer prices, and for inflation in destination markets for Chinese goods. But I personally think we're still quite far from that. China obviously has had policies in place to protect reputation, nothing more so than the Olympics, which kick off in less than 3 weeks' time in Beijing. And whilst it looks inevitable that Omicron will take hold in a greater way in China, it doesn't look impossible for the Chinese to continue to contain it by imposing these bubbles and advising their population to restrain their travel plans over Chinese New Year.
Just looking at the year ahead, given all the dimensions that you just articulated, would you expect Chinese oil demand to grow again on 21 levels, or be same, or where do you see the average over the year, given that this was the first year of decline since records started 20 years ago, into 22? What's your outlook for the year?
Given what we're seeing, it doesn't look like China is going to shrink its demand. I agree with Christopher that the growth rates are not what they are, and we will see the manifestation of lockdowns and cancellations of flights, etc. But it's still not happened on a large scale there. I mean, it's 2 months ago, many cities in China were not even wearing masks in terms of majority of people out there. That has changed. I mean, it's kind of convenient in cold weather as well to have a mask over your face, but it's been a society that's been relatively COVID-free and carefree about things. And with the issues in the property sector aside, many other sectors of the Chinese economy have still been looking pretty robust. So it is very hard to see a shrinking China.
Okay.
Of course, it is. There are many people, representatives of many companies out there that would like to paint an energy transition scenario because that's the right thing to say in terms of their investor base and global society, global opinion. But the fabric of Chinese society is still heavily oriented towards manufacturing and energy consuming businesses. And yes, you will see a blip in Q1 as well, not just the Q4 data that we'll see tomorrow, because China has shut down already many emitting, polluting industries around Beijing to keep the skies blue for those Olympics. But no, I don't see China shrinking at all. Cannot.
Close out the comments for today. Mike, obviously there is a number of factors looking ahead, obviously conflict in the potential of in Ukraine and Europe. Where else would you be looking at the start of this year for obviously the Iran nuclear talks? Every second headline seems to contradict the one before. Yes, they're going to do a deal. No, they aren't. How significant that would be from the point of view of the supply beyond OPEC plus?
Yes, I'm glad we've turned to geopolitics because it's really important and it is underpinning this price surge. There is a bit of a geopolitical disruption premium there too. So you mentioned Iran. I mean, the big question, I guess, is how high is it up on the agenda of priorities for the Biden administration right now? And Joe Biden and his team haven't had the greatest of weeks. They've had a whole bunch of setbacks internally. There's no way that he's going to be able to push a softening of stance and concessions to Iran through the House. He just won't get bipartisan support for anything like that. But there was a lot of talk from some commentators closer to Iran that there is a a new willingness on the Iranian side to see if they can cut a deal as they move closer and closer to having that threat up their sleeve, which is to have nuclear weapons capability. Now, there are some who are arguing that if given a free drop, the Biden administration in Tehran would get it on and do some sort of less for less deal, as they're calling it. I think the market mood, the market thinking is that we will not see any Iranian oil come into the market over and above what's already leaking out, and sanctions not being enforced on some of those flows, by the way, until maybe Q3 this year or something like that. So the price that we're seeing now includes some people adopting a view that maybe you'll see the return of Iranian volumes sooner. But the question is in what shape or form. If they can't be done in a sanctions being dropped way, is the US going to just allow Iran to bleed more exports into the market, even more so than is the case now? Because you are seeing in excess of 1 million tons a month of fuel finding its way into markets without any sanctions being imposed, on top of the crude oil flows that are being given blessings. And of course, the diluent, also known as South Pass condensate, that's being shipped to Venezuela to help restore production off a very low base there in Venezuela. So that's Iran. Big question mark there, but most consultants seem to think that we'll get Iranian oil in the market in a significant way sometime later this year, and that, I must emphasize, is in the price. But I have to come back to Russia because, of course, that's been the focus of attention around gas markets as well in a very big way. And in gas markets, the hype in prices has definitely led to demand destruction in various sectors. I mean, some countries that just couldn't afford $40 per MMBTU gas just impacted their high energy consuming sectors. The textile sector in Pakistan is way down on what it would normally be churning out. Manufacturing of fertilizer, urea, expensive, dropped. I mean, even across Europe still there are certain industries that are not churning out things. And that inventory that's not been made is going to have to be replenished at some point. But it does serve to remind us that people will abstain from buying expensive energy at some point. And the question is, at what point does that kick in for oil? Much less evidence of that so far. So I'm afraid I voted at the higher end of your spectrum in that poll you just did. But the cyber attacks on Ukraine in recent days are a reminder that it's not about military force. I personally do not think we're going to see Russian tanks rolling into the Ukraine, causing an international provocation, because all that's going to do is take the rest of the Ukraine, the Kiev and the western parts, into an even more amenable towards NATO stance. And I think Russia's objective is to avoid encirclement by NATO forces in former Soviet Union republics. So I think it's a very delicate balance there, and I don't think we're going to see a military action of that sort. But the Kazakhstan incident, where the international community, in fact, welcomed the action, despite the fact that there are now allegedly 200 and something casualties, and the restoration with the loss of only one Aframax worth of oil, it seems, throughout that episode, serves as a reminder that, I mean, Kazakhstan and Russia are pretty close.